Good morning, everybody, and welcome to the show. This is your host, Graham Neary, and I'm delighted to be back with Taking Stock. It is a busy morning for news, which is quite unusual for a Friday. Usually, Fridays can be a bit quiet, but we've got plenty to digest this morning. We've got a couple of fundraisings to look at. We've got range of updates, statements, and so forth. So let's get straight into it. And as always, please do hit me with your comments and questions and suggestions, and I will do my best to get back to you. Okay, let's start with let's start in no particular order, but let's just get a quick update out of the way. We'll look at an update from SigmaRock. So yeah, just let's get the big companies out of the way first as much as possible. 714 million pound market cap on this one, and it is in the quarry business. And we've got an RNS, an AGM statement, which pretty much confirms that everything is going fine at this company, in line with expectations, integrating businesses well, and ahead of budget. Volumes 1% ahead of budget here. So everything seems fine there. Not a business I've studied in huge detail, but I'm glad to see that it is performing in line with expectations. In terms of economic consequences or implications, I would note that they say there is no major change to underlying economic conditions, some markets performing well, and others still experiencing some softness in demand. So, the economic situation has been a challenge for many companies, and I think I included it in the headline yesterday. But we are starting to see signs of recovery, and that's going to be a bit of a theme for today. That there are some signs of economic and financial sentiment improving. So let's move on to an example of that. Let's look at Premier Miton. So this is a fund manager, and I think the shares are up today. Let's see where we're at with Premier Miton. So we're up 9%, market cap £104 million, and we've got an AUM update here. So let's click into this. And so here's some evidence that sentiment might be bottoming out. Stronger environment for mid and small cap stocks supports outlook for improving fund flows. So, as you may know, I have been following the fund managers with great interest, looking for signs that sentiment may be improving, that we might be getting back into a new bull market, and the fund managers are starting to give us evidence. What were we looking at yesterday? Polar Capital, and they had small inflows in the most recent quarter. Amazing news. What have we got with Premier Miton? Well, we don't have inflows, unfortunately. We have £260 million of net outflows, but it's still a pretty decent performance. Again, we have AUM rising, £10.7 billion closing AUM as of the 31st of March, up from £9.8 billion of AUM. Now, admittedly, this does include some acquisitions. So they got £560 million of AUM from acquisitions. But even if you ignored that 560, they would still have managed to increase their AUM in the quarter. So it's still a very good result from that point of view. the point I keep making is that their AUM is rising for many of these fund managers, even if you exclude acquisitions and even with significant outflows. But hopefully the outflows will start to end soon. Uh, Now, they say continued strong relative investment performance with 68% of funds in the first or second quartile of their respective sectors since launch or fund manager tenure. It is very important to be skeptical of these numbers because and it's not specific to Premier Miton. This is a broad statement about the fund management industry that there is survivorship bias kind of baked in to fund managers, and so that is important to understand. And the other point is that when fund managers compare their performance, they always do so in relation to quartiles. They are not actually comparing themselves to benchmark. The industry as a whole or on average may underperform a benchmark, but the median performance is what they compare themselves to. So that's something else to be aware of, an important point for people who invest in funds. But I will say that this 68% number is certainly fine. It's perfectly acceptable, and they have a similar number over 1 year. CEO comment, and I think these comments from fund manager CEOs are very helpful for giving us an insight into the investment outlook. And what do they say? They say the backdrop, I think, fast forwarding to this paragraph, he says the backdrop for active fund sales in the UK retail market has been challenging over the period, as it has been since interest rates began to rise at the end of 2021. We are now at a point where interest rates are likely to trend lower as we move through 2024, and we believe this will support an improving environment for fund flows and asset values that should particularly benefit Premier Miton. And he refers to the potential of mid-sized and smaller companies to deliver significant long-term outperformance over index strategies. And it is an important point that if you as a fund investor, you are taking a bet that your fund manager will beat the index. And so really the way to do that sensibly, in my opinion, is to buy funds where there is a very good chance, based on the structure or the segment that the fund manager is investing in. So for example, if you invest in a small cap fund, well, then you can hope that the small cap index will outperform the large cap index. That's what financial theory says. So one way to try to beat the FTSE 100 or the FTSE All Share would be to invest in an active small cap fund. So that's just one approach. So I think there's a lot of logic here. I think this is a reasonable statement. Let's look at the box here, just confirming that we have net outflows during the quarter, most of the outflows being in multi-asset funds. The equity funds didn't really lose much, only lost 1% of their opening value during the quarter. So pretty good stuff. And of course, we've got market performance lifting AUM as well as the acquisitions. So I would say this is an excellent bit of news here from Premier Miton, and I can see that the shares are up 9%, which makes sense to me. Okay, let's move on to something else. So that was Premier Miton. Let's deal with some more good news. Let's stay with the good news for now. Let's go to SYNT. Excuse me, SYNT, SYNT. Okay. So we've got some good news from this company as well, and hopefully another sign of investor sentiment improving. The share price up 6%, decent sized company, market cap £445 million. And it's very simple. They've had a successful refinancing of their debt. And what I would point out is that this interest rate is, in my opinion, impressively low. So they've raised 350 million euros. They are going to use that money to repay or repurchase certain existing notes due in 2025. And so then they have these new notes which aren't due until 2029, which is, I guess, 5 years away. So a successful refinancing. And I just think that if you're 375% is a very nice rate to be paying on your debt in this economy. And well done to them for locking that in. The chief financial officer says, "We are very pleased with the substantial support for this transaction, which represents another major milestone in improving our financial platform." So well done to them, and hopefully this is a sign of, again, investor sentiment picking up, and companies getting good refinancing deals. Um, in a similar vein, let's look at a company that may surprise you. Premier African Minerals. Take a quick look at this one. So market cap £51 million. Shares are down by 5% today, but I think the point here is that that they've raised money, and I didn't realize that CMC markets were quite active. It's not the only RNS out today which mentions CMC markets trading as CMC CapEx. So that's interesting to me as somebody who follows CMC, that they're involved in quite a few of these deals right now, and they say that they have a very inclusive way of allocating shares to professional investors and institutions who want to be involved in these deals. Anyway, it's only a £1 million deal, but I just wanted to mention we have a few fundraising announcements today, and I think it's a sign possibly of a little bit more enthusiasm from investors. This is based in Zimbabwe, this project. So not the sort of thing that I'm known to follow, but possibly investors are feeling a little bit more enthusiastic. Let's give you another example. So let's take a look at TERN. So another company with a fundraise today. Now these shares again down 21%, and so it's not being treated as very positive news by investors naturally, but there is this interest in raising funds, which we've seen so little fundraising over the last year or two. I think it's interesting. So we've got now, as I said, the shares are down today because this is at a discount of 30% to the mid-market closing price. So a pretty big discount, not the sort of discount you want to see as an existing shareholder. They've raised funds at 2.4p, so the share price has fallen. It's quite reasonable for the share price to fall to 2.7. So when you get a fundraising, you expect the price to fall towards the placing price. So that's a reasonable fall in the circumstances. But again, look, we have mention of CMC markets again acting as an agent and getting this fundraise done. So CMC quite busy in the last few days. The net proceeds of the placing will be used to provide the company with funds to invest in Wild Networks. I think TERN strikes me as obviously, I mean, I'm not saying anything too outrageous here. It's obviously, sort of a high risk venture. I think that goes without saying. They're investing in small technology companies, and it may work out, it may not, but uh, you know, at least there is a little bit of interest to keep funding them, which so things could certainly be worse. Um, okay, let's move on. Yeah, so we have to cover a few companies where the news is less positive. But maybe before I get into that, I just wanted to comment on we have this article from John, which I thought was excellent. Um, view from Vox, London, we have a problem. Uh, so John Human pointing out some of the basic problems in the market right now. Um, so I'll just read this out for you. I invite you to read the entire article, but he says, um, by July 2023, a steady stream of delistings and takeovers, alongside a hiatus of IPOs, had seen the number of UK listed companies slide to 1,900, a decline that has continued in 2024 and leaves the market with 40% fewer constituents than its 2007 heyday. So, yeah, a remarkable slide from over 2,400 companies listed back then to 1,900. And you would think that over time the number of listed companies would increase over time rather than decrease, but not so. It's a remarkable change. Now, there may be some of the listed companies may be investment companies where the rationale for their continued existence is no longer there. There's been an argument that we have too many funds, and maybe there are too many investment trusts. There may be a case for reducing the number of funds and reducing the number of investment trusts. So if there are trusts included in this figure that have reduced, well, then maybe that makes sense. But surely you'd still expect that over a course of 8 years, I suppose this chart goes back to 2015. So you would expect that over the course of 10, 15 years, that a stock market would grow. And it is remarkable that it has shrunk over that time. So John, in his article, points out that there is a simple explanation: a lack of interest in UK equities that has seen 34 months of net outflows and left the UK the cheapest major market in the world on a PE basis. Now, you could point out that the banks are unlikely to earn high PE ratings, and the Oilers are unlikely to earn a high PE rating either. So that is a simple explanation. And we've had a big run up in the oil companies. So that is one explanation for the cheapness. But as somebody who studies mid caps and small caps, I see the cheapness broadly across the market. And so, yeah, John talks about some of the companies we've been looking at in this, in these videos. And here we've got weight of the 10 largest stocks in the US stock market. So pointing out that it is very concentrated over in the US, in the Magnificent Seven. So that is a point. John refers to the headlong rush into US tech, and I think he's absolutely right. And it is a source of risk. And the way I tend to read sentiment is, and I'm not proud of this, but I tend to be on Twitter, and I just sort of see all these people posting about how well they're doing with passive US indexes, and nothing wrong with that. But I do think that there is complacency there for people who are invested in funds that are very concentrated in the Magnificent Seven. As you can see, 30% weight of the top 10 largest stocks in the US stock market, approaching 30%. That is remarkable. Another interesting chart from John: households in Europe own much less equity than US households. The UK is actually even lower than the euro area, which is again surprising. You would think that with the popularity of ISAs, although of course many of them are cash ISAs rather than stocks and share ISAs, but you would think that with the popularity of ISAs, with the excellent heritage and reputation of the London Stock Exchange, and with broader financial literacy in the UK being reasonably good relative to many European countries, you would think that households in Europe would households in the UK would own a decent amount of equity relative to their European counterparts, but it doesn't seem to be happening. Anyway, this is an excellent article, and I recommend that you read it. He points out, to finish, that private equity has noticed that London's markets are home to many companies that are simply looking far too cheap. And, and it's not just private equity, of course, it's also trade buyers. And we've seen that this week with Store. So between trade buyers, private equity, and companies simply choosing to delist because they couldn't be bothered anymore, there's there's a lot of reasons to leave. But I if you look at the type of companies that I've been positive on, you will see that I have pointed at companies that have performed pretty well over the past year or so. Again, many of you may know me from Stockopedia and my best ideas list over there, and Paul Scott's best ideas list, and also the not just our ideas, of course, lots of ideas, but there are plenty of companies that have performed well over the last year. So I still believe in the opportunities. It would be pretty sad if I didn't, but I think I've proven that there are opportunities by pointing out certain companies that have done extremely well over the past year or two. So it's not all doom and gloom. Anyway, that's enough about that article. We do still have some interesting stories to look at from today. I wanted to take a quick look at Randall and Quilter. So this is one that it's down 42% today, market cap £12 million. So as soon as I said it's not all doom and gloom, I have to look at a company down over 40%. But I just want to point this out. Very complicated story, very complicated insurance business. But there is a risk here, a huge risk related to the company's finances. They've been trying to get this disposal over the line. It's not over the line yet, but when it happens, it will enable them to undertake a material financial deleveraging of R&Q, return the capital solvency position back to target levels, enhance their ability to execute strategy, and so on. So they're still waiting on that very important disposal to happen. Unfortunately, the business that they're selling is the profitable one. The business that they're keeping is the unprofitable one. So this legacy business is I mean, I don't know the exact latest figures, but I've studied it before. It has been massively unprofitable in the past, and what the news today is not good. They're talking about an adverse development of 23% of net reserves. And then they go on to say, based on preliminary information, they anticipate a significant pre-tax loss for the year, driven by adverse development in legacy, that's the business that they're keeping, and a material increase in corporate costs in relation to the sale of accredited. And now they are trying to do another disposal to raise cash in order to pay down their revolving credit facility and retain cash in regulated entities. So this is a complicated story. I've been steering very clear of this one, only occasionally pointing out that it's extremely complicated and there is serious financial risk here. Might be worth, for people who like betting on horses and things, it might be worth a punt, but very, very risky. And I'm sad to see that it is heading towards an even lower market cap today. Okay, let's move along to something else. Let's do a positive story. I want to mix it up. I don't want constant gloom. I want a mix of good and bad. So let's do this huddled story. Now, this is another small company, but it is a good news story. It used to be called Let's Explore. Shares are up 8% today, market cap 9 million, so it's only tiny. But the point is that they've made an acquisition, 300k acquisition. So they've already got this Discount Dragon website, and now they're buying a Food Circle website, foodcirclesupermarket.co.uk, and they say that there are synergies. They say that Food Circle is complementary to Discount Dragon and is the next step in the group's strategy to build a portfolio of e-commerce brands. So if you like investing in e-commerce shares, this one should be right up your alley. Food Circle serves customers across the UK, has been a trusted partner for well-known brands, only founded in 2018 by two owner-operators. But look, if you like e-commerce, there's definitely a story here. There's a plan. They're ambitious, and that's really all I ask for from the small companies like this. £10 million market cap. Just want to see some ambition, and that's what we've got here. I also note that the 300k acquisition is not 300k on day one. It's actually only 100k on day one in cash plus 50k of shares. The rest may or may not be paid. And CEO comment from the chief executive of Huddled. He describes it as an exciting opportunity to further strengthen our position in the online surplus food and drink market alongside our existing brand, Discount Dragon. It's positioned at the intersection of a number of market trends: the continued search for value among consumers, the demand for e-commerce and direct delivery services, and the growth in health and nutrition products to support active lifestyles. So turnover £1.4 million. So they're only paying, for a 1.4 million turnover business, they're not paying a huge amount for that, and it seems like a good plan. So good luck to them as they try to build an e-commerce empire. That is Huddled. Okay, where shall we go next? Okay, I probably have to mention this one, although it is unfortunately not the best news story. Petrofac is down 23% today, and market cap is still substantial, £134 million. This share has been around for a long time, and it is very, very bouncy. It's been a volatile stock for as long as I've known it. The description here: a leading international provider of infrastructure solutions to the oil and gas production and processing sector. So this trading update, I'm afraid, is grim reading for Petrofac investors. So let's begin. The point is, um, they are, well, they are in significant net debt. So I'll just point out this sentence. Excuse me. Is this giving me the right? Oh, this isn't correct. This is April 12th, 2023. All right, that's no problem. I will go to a different website to get the latest one. Um, let's try something else. Petrofac. Okay, so I'll use a different website for this. 12th of April 2024. Petrofac update on strategic and financial options. Let's just change the format here for a minute. Okay, so I'm not going to break anybody's copyright or intellectual property. So I'm just going to give you the news here myself for a minute. Petrofac update on strategic and financial options, 12th of April 2024. So Petrofac provides an update on the status of ongoing negotiations as part of its review of strategic and financial options. The company has engaged and remains in discussions with its lenders to restructure its debt, which would result in a significant proportion of the debt being exchanged for equity in the business. It also continues to be in discussion with other people in relation to potential further investment in the company and remains in negotiations with prospective purchasers regarding the sale of non-core assets. So clearly, it's a distressed situation where they are just trying to stay afloat, essentially. And dilution is looking very likely and may indeed be the best case scenario. There are times when dilution is the best you can hope for. Um, Management and the board are focused on managing the group's payment obligations and delivering a solution which supports the provision of guarantees required for its recent contract awards and which ensures that Petrofac has the appropriate capital structure and liquidity to support the strength of its $8 billion US backlog. So it's important to remember that when companies get into financial distress, things can move very slowly and then very quickly because the customers and the suppliers have a say. And if customers or suppliers don't wish to continue trading with the business on terms that are normal, then that can really just mean the end of the show. Now, in the case of Petrofac, they say they are uh, progressing discussions with credit providers and clients to find solutions with respect to the guarantees required for its recent contract awards. So basically, these contracts that have previously been signed may not happen unless people are confident enough to do business with Petrofac. And um, there is a question mark hanging over what is going to happen. So a difficult situation and not the sort of thing I get involved in. Again, this is a bit like going to the races. You know, can be an entertaining bet, but there are probably there's other ways to lose your money that may be more entertaining than betting on Petrofac. So tough situation, and hopefully they can figure something out there. Okay, let's move on, and I can share my screen again because I'm not breaking anybody's copyright. That was Petrofac. Um, all right, let's have a quick look at Revolution bars. Uh, so, subject of much discussion. Shares down 4% today. But you can see there last night we had results of the placing. So this pub group has, well, I mean, it's been a pretty much it's been a disaster for shareholders. I think that's fair enough to say over a period of time. We get a 1 year chart here. Share price much lower. Um, but of course, it's not all the fault of management. It's not all the fault of the economy either. It's just one of those things. The bar industry is very difficult, and you sort of the way I treat the bar industry is that I expect bars to have financial problems every few years. Capital intensive, cyclical demand, low margins because of all the huge costs, huge wage costs, energy costs. Very difficult business. I've never run a bar, but I've observed bar groups long enough to know that more often than not you get trouble every few years. Um, so in this case, they've managed to raise money, so it's good news that they've at least managed to do that. Um, they've raised gross proceeds of £10.5 million at from a firm placing, and a minimum of 50 million new shares in a placing and open offer with minimum gross proceeds of £500,000, which could be up to £2 million. So they're raising between 11 and £12.5 million, depending on shareholder uptake. So that should certainly help to calm things down here. Any other comments of interest here? We do have some director participation, which is nice to see. 8 million shares from for Rob Pitcher. Let's see now. Fundraise, restructure plan, and interim results. Yeah, so if we look at these interim results, just a reminder here, we've got net bank debt on the 30th of December 2023 of £20 million. So when they say net bank debt, that is excluding leases. So when I see that, I sort of have to wonder if they've actually raised enough. If they raise 10.5 or £12 million gross, they have to pay costs out of that, and then they're still going to have net bank debt after that. So yeah, it's a worry. I'd like, if I was ever going to invest in bars, I'd really want to see companies that had freehold, or if they don't have freehold property, at least have net cash. I mean, excluding leases, I would like to see net cash, but that's not the case here, sadly. So at least they say adjusted EBITDA in line with expectations. However, adjusted EBITDA, I don't think is meaningful for a capital intensive group, and bars are capital intensive. So, in my opinion, that makes the adjusted EBITDA a meaningless number. Let's have a quick look at the cash flow statement from these interim results. So I'm just scrolling down. So you can see total assets £133 million. So quite a lot of capital there. Admittedly, half of it is in the form of leases, right of use assets, but still capital intensive. Also a significant amount of PPE, so fitting out their restaurants. And look at the cash flow statement. How much was spent on capex? Cash flow from investing. So that is a good thing, that they really held back their capex in the most recent H1 period. So that will have really helped the cash flow performance. But even still, they didn't manage to keep the wolf from the door, so to speak. So yeah, this is a tricky one. I do think that the bars are very difficult industry for people who own them, for people who run them, and it's not something a swimming pool that I like to swim in very much. Okay, so that is Revolution Bars. So we'll just round out the news today. Look at this tiny one. So unfortunately, this one, Ben's Creek, looks like it may be maybe missing a paddle right now. RNS basically says they're shutting down or substantially reducing activity at their operations at a subsidiary. They laid off employees in West Virginia and care and maintenance bases. So, haven't got a huge amount of experience in the mining industry, but I know that when you see care and maintenance, that things aren't really happening. And they say that they are in discussions with their largest shareholder for additional financial support, and they are assessing all options. So, unfortunately, bad news there, and maybe this one is headed for a zero, but it's pretty close to getting there already. I'm sorry that I had to end on a bad news story, but I just wanted to round out with that one. That is pretty much all of the news from today. One or two other tiny stories, but I think that's about it. I'd like to thank you very much for joining me. If you would please hit the like button, it really helps a lot. Helps me know that people are out there and listening and soaking up the content, and appreciate all your comments. I will take some time to write back to all the comments under the videos. Won't do it every day, but maybe every second or third day I will just go through all the comments and get them all replied to. And I think that's about it. Been a busy day for news, which is good. I'd rather run out of time than run out of material. And let's hope that we are entering a brave new world of optimism in the UK. We've had inflows at Polar Capital. We've had Premier Martin seeing outflows, but small outflows, and AUM still growing. So the fund managers are seeing their AUM go up. Recession, the shallow recession, maybe we can escape that. Maybe we'll see interest rates fall a little bit, and maybe we will start seeing some positivity. I mean, there was another company I could have mentioned today, PREM PLC, which raised some money. There were several companies today that raised money, and it wasn't great news. In most cases, the share price fell because they were raising at a discount, and existing shareholders may feel disappointed that that's happened. But as an observer, I'd much rather have a market where we are at least getting these fundraisings away, and the companies aren't going bust, just purely from a sentiment point of view. I'd rather be in a market where there's a normal, functioning, healthy sentiment, and we can get some decent valuations, or reasonable, logical, sensible valuations on companies. That's all I'm looking for. I don't need a crazy bull market. Just some normal valuations would be nice. Peter in the comments says WNWD Windward might be worth a look. Was checking this one today. Thank you for the suggestion. Appreciate it. And yeah, have a great weekend, everybody. I hope to see you again on Monday, and hope your portfolios are doing well. So, with that, I guess I will pass you to the outro. Bye for now. Thank you.